This episode of Bourbon Bubba is educational and should not be relied on for investment advice. Please consult a registered professional before making any investment decisions and conduct your own due diligence. Enjoy. I'm here with Noah Sanborn Friedman, managing partner of Top Shelf Ventures and Uncharted. It's good to be with you, Noah.
Good to be here, man. Thanks for having me.
It's a genuine pleasure. So, if you wouldn't mind, can you just give us the quick 30 seconds on Top Shelf, what you do, what you're about, what stage you are?
Yeah, of course. So Top Shelf Ventures is a venture and private equity fund focused explicitly on the alcohol industry and adjacent highly regulated but underserved by venture industries. We started about 3 years ago, have closed our fund one, and have just started investing out of our fund two. Our whole model, generally speaking, is that we survey, monitor, measure the entire landscape of everything that's happening in the booze world. We have a mix of an advisory network and some internal AI systems that we've built that essentially allow us to say with some level of confidence, we see everything that's out there. We look for the outliers in terms of quantitative, qualitative metrics that we believe set them up to be disproportionately successful in the next 5 to 10 year window. We try to take aggressive, founder friendly positions in those companies, help the founders accelerate the businesses, and ultimately lead them to either an exit or some sort of liquidity event or just make them super profitable. It's worked out pretty well for us thus far. And we're excited to continue to carve out what we believe is a really compelling and valuable niche in a really massive and lucrative industry.
It's like you've given that spiel before.
I actually haven't pitched it that way before. I kind of just riffed, but I'm hopefully it landed.
Said it's underserved by traditional venture. So I don't like
Yes.
I've been on that real quick. Why is the alcoholic industry like underserved by traditional venture?
I have hypotheses, and I'm sure that they're directionally right in many. It continues to blow my mind why there's not more people in the booze world. I think the short answer is people don't understand it. It is a historically highly regulated, somewhat veiled in ambiguity industry, and it has a series of laws on the federal state level that date back to Prohibition. And so, for an uneducated investor, it can look and seem overwhelming, which in many ways it is, but it's not impossible. But I think a lot of the reality is that traditional consumer funds have often said we are either going to stay clear of alcohol entirely or we are going to make one or two token bets in the space. The thing I think many of them are missing is that the nuanced metrics, route to market, and path to success in alcohol can be so different, specific, and kind of in its own lane compared to traditional CPG that having some level of dedicated focus on the booze business, I think, can be massively asymmetric. It's really why we've tried to say to the industry, we're going to lead the charge in booze. If you want to participate in this industry, kind of follow our lead. And we want to obviously bring in as many consumer funds that want to participate as possible into our deals. But it's why we've really said we're going to focus on this and really try to own this space.
Awesome. That's one of the things I love about it. Just, the world is so competitive at the institutional capital level, but within spirits, there are, I can count on my fingers the amount of institutional funds like purely devoted to it. And it's $100 billion industry. What's your background? How'd you end up here kind of on the investing side, focused on alcoholic beverage sector?
Yeah, the quick story of how I fell into this, as many people in alcohol do, is I started my career with a current mentor, partner, and friend of mine named Michael Loeb, who took me under his wing as an intern. And one of the first things I did for him after working from him from college for a while, working for him from college for a while, I'm sorry, was helped run and kind of start an alcohol analytics business that I worked on for several years, kind of became COO of when I was pretty young. I was 24 and I was running this business that had a team of 15, really tackling the analytics and lack of available data in the alcohol space. And we built that business to be fairly large. We were processing billions of dollars of receipt level transaction data. My read as a aspiring entrepreneur and investor was a lot of what you just said, Bubba, which is there is a ton of money changing hands in this business. It is remarkably lucrative. It often trades at tech or better level multiples. The big players are super acquisitive. They largely, by necessity, will treat their M&A as their R&D, meaning they're not very good at launching their own brands and they're really good at acquiring and scaling brands. And then I would see both in our data and across the ecosystem that there was all these companies launching on a yearly basis, new brands with really compelling pitches and really compelling teams, very similar to the tech ecosystem of lots of new guys and girls will go out and start new companies every year that are very credentialed and have great ambition and vision. In tech, if Noah and Bubba want to start a tech company or an AI company, we can throw a stone and hit 15 funds that want to take our meeting. And I would ask all these new alcohol companies 5, 6 years ago, hey, you guys have a great product, you have a great team, it looks amazing, you're getting good metrics. Where are you raising money from? And the answer was always There was no good answer. It was always like, the founder's uncle runs a hedge fund, or they did a friends and family run, and there was just no systemic players in the space that could price rounds and be strategic money. And to me, that was crazy for how lucrative this business is, that there was no Andreessen or Sequoia or Excel or Insight Partners that really could be sort of the captain of the industry in terms of seeing everything, pricing deals. And that was really what kind of sparked in my brain. There's something here on the institutional capital level. I then met my now partner, Jason Sherman, who has a lot of experience, obviously being deeply involved in AV InBev's venture arm and both deploying capital and acquiring companies. And so that's really, a long-winded way of saying we saw an opportunity in the space. We saw a massive white space in terms of who else was doing this. And we said, who better than us to go tackle this and try to be the preeminent fund in the space?
It's still crazy how much of a white space there is. I mean, even 6 years later, a ton of my subscribers are kind of managers of capital. So that's, large family offices, $1 billion plus, consumer private equity, consumer
Sure.
venture capital, showing some interest kind of in the sector. So if you were to compare it to traditional CPG investing, like cereal, ice cream,
Mm.
energy drinks, what is similar about kind of the alcoholic beverage and what is different?
It's a great question. Look, the biggest thing that sticks out is that the acquisition time frame and framework in alcohol can often be, in a beautiful way, quite different from that in energy drinks or cereal or beauty or any other non-alc CPG category. Generally, if you think about, if I want to start a Coca-Cola competitor or a Frosted Flakes competitor or a new beauty brand, it's generally accepted that I'm going to have to hit 50, 60 million in sales before I'm even in scope to have conversations about acquisition. And in alcohol, that conversation will generally start meaningfully earlier in the curve, largely because it is kind of just this accepted fact that the big manufacturers are so hungry or thirsty for new innovative concepts that can help them retain share of wallet of their customer. I mean, you have to remember a lot of these companies that are so acquisitive are publicly traded businesses that trade on share of wallet, i.e., how much of Bubba's wallet does Diageo control? When he is drinking, is he drinking Kettle versus Tito's? Is he drinking this tequila versus that tequila, the new RTD versus that new RTD? And consumers get bored in the booze space, but they're remarkably lucrative customers to own. And so it often ends up being cheaper for Diageo to acquire a company doing 10 million in sales for 100 million than to wait for that company to get really competitive, lose way more than that in market cap because they're not competing well enough, or try to start their own, which they're generally quite bad at. So in the booze space, the M&A cycles tend to be much more aggressive, quick, and frequent than in non-alc CPG. And for me as a venture investor, with exception, this is obviously not always true. It will often mean that it requires less capital to get to a point where you could be looking at an exit, right? It could be an order of magnitude less money required to get a brand to a spot where it's in scope to get acquired. This obviously doesn't happen all the time, but in a venture portfolio, if it happens 1 out of 10 times and that company goes on to be worth a lot, the math works. So, non-alc CPG, cereal energy drinks are super hot. Great business, remarkably competitive, tougher margins because the route to market is easier, meaning I don't have to deal with three tier. The market often gets more crowded, and there's a whole bunch of other kind of nonsense that happens on the way to the shelf. You can look at that as a positive or negative. I look at it because we understand booze, we understand how the distributors works, we respect them, we know how to work with them, we're friends with them. I look at it as somewhat of an accelerant and tailwind just because like we know how to play in that competitive landscape, which most others don't. But there's a lot of similarities, but it is quite different. It's its own lane for sure.
You've used kind of like venture terminology quite a few times, like drawing allusions to Sequoia and Andreessen. Do you think kind of venture capital or any other asset class would be like a helpful benchmark to understanding kind of the nuances of AlcBev or just beyond traditional CPG?
Sorry, I want to make sure I understand the question. Do I think venture capital is a good analog for
Yeah,
alcohol?
that's a good question.
Yeah, I think so. I mean, look, this kind of goes into the risk of investing in any company directly without really understanding what to look for, right? It's good angel investors obviously have a lot of reps under their belt and they can pick things effectively, but a lot of it is spray and pray and hope you get lucky. In booze, we see all the time, and I think you kind of mentioned this, a lot of people know someone who's lost money on a booze deal because your buddy from college launched a bourbon and the deck looked great and the thing tasted good. So you said, of course you're going to be the next Casamigos, not understanding the nuances of what it actually takes to be a backable, scalable, and competitive bourbon, right? And the difference for a lot of people who just say, hey, we like that drink, we like the deck, we like the founder, versus us who take a very quantitative approach to understanding exactly both how much money it's going to take and, more important, what core metrics that brand is showing in market that lead us to believe it is a dramatic outlier from the rest of the pack. There's a very big difference between those two things, right? So we take both the portfolio approach and we underwrite every one of our deals to at least a 10x plus of seeing why the core metrics that they're showing, either online or in store, and exactly why that's so much better than the competitive set, how we can get it in a valuation, help the brand accelerate in a way that across the board, we feel confident that several, if not all of these companies have a disproportionately high chance of being one of the outliers in this set of brands. That's a pretty markedly different thing than a normal approach of just like, hey, Bubba, you're a great dude. You know, the bourbon tastes awesome and your deck is great. I appreciate that you paid a designer a bunch of money to do it. Like, we're in for 100 grand. Like, that's a pretty good way to lose money. You might get lucky. And there's a lot of people who did get lucky and, you know, they funded Casamigos or they funded Whistlepig or they funded any of the big ones that have come in and crushed it in the last 5 years. That happens all the time, but you really have to know what to look for. And more importantly, you want to have somebody managing that investment that's going to make sure that it's on its way, because these things, you know, can very quickly spend too much, not keep in check with what they should be spending on, what the normal metrics are, et cetera.
I've never seen that before. I don't know what you're talking about. Venture capital, so power law, like one investment returns, the majority of the returns of the portfolio. These alcoholic beverage have that capability. They can
Totally.
10x individually, but it's not necessarily where you're making 50 bets of $100,000, spreading that risk across 20 other venture capital firms that are all investing, and hopefully kind of it works out in the averages across it. Like, you do have to do more diligence, especially because there aren't 20 other venture firms that you can share that risk with. Like, you really have
Totally.
to make those concerted bets. You can't rely on a lead investor from some other firm to tell you like this is legitimate. You got to do the
That's right.
yours.
And the other thing I'd say is that the the chasm between, I'll just give several examples of this. The chasm between investor A or top shelf gets a pitch from a company that on the surface looks amazing, right? The can or the bottle is beautiful. The founder sounds credentialed. They are showing really good metrics in the deck, which end up being vanity metrics, but they're showing really good metrics in the deck. They have some like smart investors who don't do alcohol but are interested in it, and the thing looks great, quote unquote, looks great, versus we've taken the layer down in diligence and been like, whoa, this is nowhere close to what you're representing. It's a really big gap, right? So the difference between a thing looking good on the surface and being backable is really big. Backable in our mind is really big. And most sort of casual investors or LP type investors in the space don't understand the chasm and what goes into kind of bridging that gap. And the flip side is that there's a lot of companies that will end up looking terrible on the surface, tasting bad, you don't like it, but the metrics that they're showing in market make them disproportionately backable. And so I think the ironic thing here is that what most uneducated investors in this space would look for as an investment often ends up being the worst thing to start with, right? It's the worst thing to start with because you know this as well as I do, Bubba. You and I can come up with any concept you want and make it taste great in a week, right? I can have a spiked coffee taste like the best thing you've ever tried and send it out to investors tomorrow if I go to Jersey to one of the many labs that formulates the thing. That does not mean it's going to sell well.
Yeah, I often tell investors like tasting investment, CPG, alcohol is honestly really dangerous because you don't want your personal taste and your engagement to it would distract from you what really is going to drive success, which is at
Well
the core
said.
metrics.
Well said.
So if I'm a portfolio manager, I've got 100 million, I've got a billion or whatever, I'm
Yeah.
allocating that public equities, traditional VC, real estate, whatever, all that good stuff. What would you say to me like, hey, why would I allocate, like, beyond believing you guys that you can make a return? Everybody's telling me they can
Yeah.
make return. Like, what about the asset class like fits well? What problem does it solve? How does it help the portfolio balance? Like, what makes it unique? Like, why should it deserve some kind of share?
Yeah. Yeah. Well, I'll give the legal caveat for all this that this is not investment advice or solicitation, just to do the right thing. But I'd say this, look, alcohol is generally fairly uncorrelated, meaning what's happening in the tech markets and tech ecosystem and tech M&A environment often has a disproportionately high impact on the current state of venture. There's a lot of
Mm.
LPs and funds that have been around for a while that are just waiting for liquidity because the M&A window in the last couple of years has been so tight and so close. I know a lot of people are excited for the FTC chair to hopefully be removed in the next little bit, but that is a material impact on an entire industry, a venture across the board, not just AI venture, not just like just tech venture. that has a pretty meaningful impact of like it's all kind of correlated, even if the individual subsectors of the economy that they play in, whether it's AI or B2B SaaS or consumer or whatever have you, like they're all kind of bubble up to the same core thing of like how's the M&A market, how are the capital markets treating it? Like it's all in the same ecosystem. Alcohol, if you really boil it down to the fundamental thing that has to do with consumers, is pretty uncorrelated. And the reality is, when times are good, people drink. When times are bad, people drink. The alcohol industry is cyclical on the margins, and a lot of people will say that we're in a bit of a headwind cycle right now, which is largely true, but I think it's dramatically overblown. But the reality is, at its core, this is a multi-trillion dollar industry that just continues to go no matter what's happening in the rest of the world. And so, if you're someone who wants venture exposure, private equity exposure, private markets exposure in a thing that is uncorrelated from the rest of tech, and you want to see what it could, you want to have opportunities to have those big exits and just have exposure to that type of asset class, booze is a pretty darn way to get it. And I would argue that real portfolio managers and real LPs and real institutional investors, or just wealthy individuals who want a diversified portfolio of things in consumer and the broader ecosystem, should have some exposure to it.
Totally. Yeah, I think about it from VC tech. I mean, just think about Web3. Like whatever anybody believes about Web3, like you have so much risk to these cycles, to
Totally.
technological advantage and change. Whereas alcohol's had positive nominal growth every year for the last 3 decades, through the dot-com
Correct.
bubble, the Great Recession, through COVID. And alcohol's a 3,000-year-old industry, so to speak. And so you've got power law, venture-esque return profile,
Right.
but with a core asset class that has been relatively consistent throughout human history.
Also,
I see you mentioned this a couple times on kind of the return. I see a lot of investors get spooked by the lack of cash flow, whether it be substantially negative or let's just say really tight. And that's not uncommon in CPG, but seems to
yeah.
be serious in spirits. Why is it that way? Why are these brands not making money? And if that's the case, like where does the return eventually come to me in just
Yeah.
one of these investments?
Well, the short answer to that question is the bet for the brands that just hemorrhage cash forever is that they're going to get acquired, and they're going to get acquired on a multiple of revenue, which is a good bet because there's plenty of precedent to show that that will and can continuously happen. I have a perhaps somewhat controversial view on this, which is that I don't buy nor accept that brands should just arbitrarily hemorrhage cash because it's the right thing to do. I've seen examples in our portfolio, and this has kind of become my baseline for how I look at success of they run their financials well and it's a well-run business. If they're choosing to lose money, it is generally a choice once they pass a certain threshold of a few million in revenue. And I believe controversially, and I'm sure there's a lot of founders who would tell me that what I'm saying is impossible, to which I would challenge it's not because I've seen it and we're, you know, shareholders in many brands that are proving this is not impossible, that it is possible to be efficient enough with capital to not have to hemorrhage cash throughout your entire life cycle. That doesn't mean you'll be even a positive in cash flow money, but it means you'll be consciously focused on exactly where and why you're spending money. I've seen a lot of brands make the mistake, and this kind of is the norm for what the decks we see looks like of like, we're going to burn 5 million in year one and 3 million in year two and 4 million in year three. And by the time we get to year five, we'll be cash flow positive because we're going to be doing 70 million a year in revenue, which means we're just going to have enough margin of error to basically be cash flow positive, which to me is total nonsense. Sure, that can happen and that could exist. We've seen brands doing a couple million a year be profitable because they have the right mix of disciplined managers, good financials, and the most important thing, Bubba, which goes back to our philosophy, is that they have disproportionately high consumer love, retention, and velocity, which is what creates the lift on their cost of goods and revenue and marketing expense to allow them to be more efficient, right? The core thing that anyone in this industry is chasing is, are you putting a product in shelves or on the hands of consumers that they love more than they love the other people? And if they love it that much, it should move quicker through the shelves. And if it moves quicker through the shelves, you should be more efficient in how you're generating sales and cash flow and revenue and all those things. And so we are in the business of finding outliers. The outliers, if they are true outliers, will tend to have a disproportionately high ability, if coupled with really good operational efficiency and disciplined financial management, to not be that big of cash hemorrhagers, right? And so the answer is yes, it is kind of the norm in the industry. And the flip side to that is our business is, we obviously have plenty of businesses that it's why we exist, that need capital to grow and need to survive, which doesn't mean they're going to make money the whole time. But I don't buy that it is a necessity and prerequisite that these companies need to burn lots of cash to be successful. I just don't buy it. Will they burn some cash? Yes. Will they burn much and often other times? Yes. And that's encouraged, but it has to be a means to an end because that cash is fueling growth that is retained.
Totally. Yeah, I heard a great brand CEO say like hire a CFO that doesn't come from the alcohol industry.
and they're not
And
used
what
to
that
it.
meant for them is he, didn't follow the same playbooks, and the sales guys were saying we need to spend this. He looked at every outflow of cash as an ROI. Like, what is this
Yep,
creating for us? And that's
correct.
really unique in this industry because a lot of people run the same playbook. And hey, these guys spent this much to get to this goal, so we have to spend this much.
Totally,
And that's not necessarily the case. And you want to
totally.
see efficiency for your capital because that's the return at the end of the day. Well, I mean, we're getting close to the end. Everybody's seen
So
articles about how Gen Z is drinking less. It's the end of alcohol. Sober curious. We just discovered that it has potentially negative health impacts for the first time in history. How do you respond to that, engage with kind of that conversation?
I think it's mostly nonsense. Look, I think this industry's gone in cycles for years. There was a whole trend in the 1980s that happened where the mix of Mothers Against Drunk Driving and the Jane Fonda health movement really compressed the alcohol industry like 25% because people were just like, we can't drink anymore. And then in the 90s, alcohol at all-time highs again. I think what's happening right now is that people drank like fish over COVID. And so 2019 to 2020 levels spiked like crazy, and the alcohol industry got somewhat spoiled in assuming that that delta and gap between where things were in 2019 to 2020 was going to continue. So everyone produced more and everyone created more and everyone expected more and they projected more and put more alcohol into this system of the value chain. And now, in a healthy way, this is good for society. People are like, well, you know what? Maybe I shouldn't drink that much. I should kind of regulate it a little bit. And so now you're seeing people say, no, I'm going to go to run club and I'm going to measure everything I do and I'm going to be super, super healthy. I think that's good. I think it's a good thing for society. I don't think that that level of commitment to like we're never going to drink again sticks. I think that's really explicitly and exclusively in the margins of America, coastal elite cities. I think those types will swing back to drinking in moderation, which is how they should drink. That's the right way to drink alcohol is in moderation with friends. And I think that you see this mismatch where the industry's panicked because they're seeing down cycle for the first time in 50 years, where they've been had the luxury of growth every year, to your point. But in reality, for the most part, everything's still higher than it was in 2019. So if you take COVID out of the equation, you've still seen incremental growth, which is what you've always seen. And so I, as an investor, like, all right, you're telling me that there's still hundreds of billions of dollars of sales in this industry. Everyone at the top is panicked to figure out where they want to find growth. There's less capital flowing into the system because people think people are going to drink anymore. That is a huge opportunity for me because I think none of that is true. People are going to drink forever like they always have. People crave escapism, and the alcohol industry is going to continue on like it always has.
Yeah, totally. It's being a student of history. If alcohol came back from being illegal and considered unpatriotic and,
Yeah,
Nazi associated in World War II to the point that it is now, it could probably survive through some, negative BuzzFeed articles.
correct.
You mentioned you're kind of actively deploying fund too. Are you guys
Yeah.
actively raising? What's kind of top shelf in the cycle right now?
Yeah, we just did a first close of our second fund and have a great group of investors behind us. So we're continuing to raise fund two. It's going quite well. We're in a good spot with it, but always happy to chat with anyone who's interested in learning more about the alcohol business.
If anybody would like to kind of be introduced to the top shelf team, just reach out to me. I'd be happy to make the connection to you. But Noah, thank you so much for hopping on, man. It's been a great conversation and I appreciate you. I hope you have a great Friday and rest of your
Good to see
weekend.
you, brother. Always a pleasure. We'll talk to you
Yeah.
soon.